Chapter 11, cash flow statement. Now we're going to do preparation of the direct method, and this would be part 3 in this presentation. So again, we're going to do the preparation of the cash flow, which is on your homework. So again, the statement of cash flow, you can either use the indirect method, which we reconcile net income to provide operating activities. And now we're going to cover the direct method, which reports all cash receipts and cash payments from operations. So again, regardless of which method you use, you always get the same answer. So now let's take a look at the preparation of the cash flow using the direct method. And remember, this only affects operating activities. Now, with the indirect method, we start with net income and then adjust it to cash basis through a series of adjustments. With the direct method, we convert each line item on the income statement from an accrual to a cash basis. In essence, the operating activity section of the statement of cash flow using the direct method is really just a cash-based income statement. Because of this, we ignore, and remember this, you ignore depreciation, depletion, and amortization expenses because these are not cash items. They're just allocations of items we previously spent the money on, and now we're just allocating it to based on the matching principle. Now, what I'm going to do is show you some examples of how we would determine cash for the direct method. Let's take a look at trying to figure out how much cash we collected from customers. First, we'd go to the income statement and get the sales revenue, and then we'd go to the balance sheet and look at anything that would affect revenue, i.e., accounts receivable, unearned revenue. So, accounts receivable is because what's happened there is we make sales and we haven't collected the money. And unearned revenue, we've collected the money, we just haven't done the work. So in our case, we have a change in the accounts receivable balance that actually went down. Now, what does it mean when the accounts receivable balance goes down? It means that we have collected more cash than we billed in sales revenue during the year. So we begin with our sales revenue. We look at the change. And what we're going to do, since it went down, we're going to add that back in because, again, we collected more cash than we billed in receivables during the year. So our total cash collected from customers is $1,457,000. Now let's look at how do you determine how much cash you actually paid out to suppliers. Well, we have to look at actually 3 accounts. We have to look at cost of goods sold, inventory, and accounts payable. From the income statement, we're going to get the amount that's showing up in cost of goods sold. From the balance sheet, we're going to get the beginning and ending balance for inventory and the beginning and ending balance for accounts receivable. Now, to determine the cash payments, what I like to do is to do T accounts. So what I would do is I'd fill in the information provided. Now I know for cost of goods sold, I booked $758,000. Now, here's the thing. If I booked $758,000, it means that I actually credited inventory to get that amount. Now what we want to do is we know the beginning balance, we know how much went out, we know the ending balance, and now let's determine purchases. So for purchases, we know that we started with 119, we still have 135, and we transferred out 758. So that tells us our purchases are going to be 774. And we know that next we're going to go to accounts payable, and we know that's where the 774 would go. Now, if we just determine the actual cash we paid, we would take the beginning balance plus the purchases minus the ending balance, and that would tell us the amount of cash, and that is what's going to appear on the statement of cash flow from operations using the direct method. So now let's go ahead and prepare a cash flow statement. We have this list of items, and what I like to do is if I were working this problem, I would print this out and I would check them off as I use them and why I did or did not use them as an aside. So first, what we want to look for is anything that would be identified as a receipt from operations. So the first would be first, what we would do is look at the change in our cash account, because that tells us in the end our total cash has to equal $39,300. So the first thing we would look at as receipts would be our collection of interest, our collection from customers, and our cash receipt of dividend revenue. So that would be our receipts for cash flow from operations. Now what we're going to do is we're going to look at what disbursements did we have for operations. Well, first, we have the payment of the salaries, which would decrease it, payment to suppliers, and payment of interest and expense, and payment of taxes. So now you notice I'm checking all these off as I go. And now what I would do is add them all up and subtract them from the receipts, and that gives me my net cash provided in this case by operating activities. Now we'll go to investing activities. So we're going to invest anything that's an investment. Well, first would be we purchased equipment, fixed assets, which would decrease our investing activities. And then we sold a piece of equipment, and that would increase investing activities. Now we're going to put that on our cash flow from investing activities. And now in that case, we used for investing activities. Now that's not a bad thing, because when we used the money, we used it to buy more equipment. So that's always a good thing. Now the last thing we want to do is look at financing activity. Well, we issued stock, that would increase cash. We paid dividends, that would decrease it. We paid a long-term, we sold a long-term note. No, I'm sorry, we issued a long-term note and we received the cash, and then we paid one off. Now, we still have one more item left. Depreciation expense. Remember, that's a non-cash and we ignore it. Now we can finish up our cash flow statement from operations using the direct method. And there it is. And if you notice, the change equals the change in the cash account. And that concludes this presentation.